Hey guys, good afternoon. Today is Monday, November the 4th, 2024, and well, we did it. We got through the sell in May and go away months, and we are now into the back to school, back to work season and into the winter months. There's a lot going on for this update, so I'm going to move quickly. Many people have asked whether the presidential election will have an effect on the markets and in which direction. I've studied this phenomenon as best I can. I'm a student of historical market trends. And the best answer I can give you is that historically speaking, the outcome of the election has very little impact on which direction the market goes after. The market has both risen and fallen during both Republican and Democratic leadership. However, the economic policy, tax policy, and global leadership does have a more significant impact. And if we want to evaluate which way the market will go after an election, perhaps it's best to look at the policy each individual candidate would want to implement. With that in mind, let's note that last Thursday, the Dow had a gap down of several hundred points, but very quickly made it up on Friday with a 500-point plus upward performance. October's weaker than expected jobs report suggested that the Feds would be more open to reducing interest rates further, but now today I see the market is off a few hundred points yet again. More importantly, we have seen downward revisions in employment numbers for both August and September, which again calls into question the accuracy and reliability of government reporting. If we can't trust the data, what can we trust? And also of note are several reports, including the Vegas betting pools and other things, which suggest that the Wall Street is already pricing in a Trump victory in the election, and it's generally expected that a Trump presidency would accelerate the economy, and that's also likely contributing to market strength in the last week or two. For whatever reason, no doubt there is upward momentum for both the S&P and the Dow, and whether that is sustainable or not remains to be seen. There are many significant challenges in our economy. Still, it's difficult to ignore or write off the increases we've seen in investments over the last year or so. And trying to tell the market it shouldn't be as high as it is would be like telling the ocean what kind of waves it should make. For whatever reason, growth domestic product remains solid and upward momentum is apparent. In my view, moderately aggressive investors could consider adding to their growth positions, and maybe, just maybe, for a little while. Although I would continue to recommend that financial planning investors should deploy some level of risk mitigation. In other words, if things go south on us, that there is some mechanism in your portfolio or investment holdings that would reduce the downside risk. Obviously, there are many choices in that space, and please give us a shout if you would like to discuss. As positive as the recent performance has been, there is still an overwhelming chorus of warnings being sounded, from broad-based generalizations to technical analysis to thoughtful research reports from well-respected firms. The continuing chorus of reports suggests that there is a major disconnect between the performance of the market and the fundamentals that would make such performance occur. There's major disagreement over whether a recession is imminent or not, or whether the mythical soft landing might be more in the cards. Some reports suggest that the market has far exceeded where it should relative to the anticipation of federal interest rate cuts. And behind the scenes, it's important to know that many Americans are falling behind on their bills, and that American consumers are running out of money. Is it possible that recent consumer spending and therefore GDP growth is financed primarily on personal debt? Quite so. Speaking of debt, no doubt the federal budget deficits and national debt continue to be of grave concern and are notably absent from the election dialogue. One of the best research departments from First Trust out in Chicago publishes a lot of meaningful analysis and thoughtful comment on this stuff. In summary, they suggest that there is simply no excuse for running a deficit this large given the lack of a major war and the absence of a recession. And yet, here we are. Interest payments on national debt have reached historic levels of a high never before seen. $881 billion of interest payments recorded so far for 2024, which is the largest interest payment ever recorded. As interest rates rise and the government accumulates new debt from deficit spending, this figure is likely to climb higher. Even Elon Musk has repeatedly sounded the warning that our country will go bankrupt, and soon, if we don't fix this. Government spending is out of control and far exceeds revenues by the largest margin ever recorded. Not only is it the United States, the world is drowning in debt. While the United States national debt exceeds $35 trillion, worldwide global debt exceeds $315 trillion. And the problem continues to worsen despite the already critical levels. If you followed these videos for a little while, you'll know that I am a student of Ray Dalio and have closely followed the scenarios that he has outlined in his book, The Big Debt Crisis, ever since it was published in 2018. In a recent article, Ray Dalio suggested that China may face problems as severe as Japan did in 1990 and that their economy is sputtering. And even though they are a fire-breathing dragon on government steroids and certainly an economic force to contend with, their economic nightmare is far from over. Even Saudi Arabia has recently slashed growth forecasts and sees wider budget deficits going forward. Couple this with geopolitical pressures in the background and the outlook gets even starker. China's shipyards are cranking out new warships at a breakneck pace. Say that 3 times fast. And China recently test fired an intercontinental ballistic missile for the first time in decades in an apparent saber-rattling move. Ballistic missiles are the ones that go straight up like a moon rocket, leave the Earth's atmosphere, and then come back down at more than 15,000 miles an hour to hit their target. Hezbollah recently fired one of these towards Tel Aviv in their first ever such use of a ballistic missile. Fortunately, that missile was intercepted by Israel's missile defense system, but which now marks the very first time in history that combat has ever occurred outside of the Earth's atmosphere. Meanwhile, North Korea is sending troops to join Russian troops in the Ukraine war, and Russia recently redeployed an aircraft carrier's crew to fight instead on the ground. Clearly, the Ukraine war is a huge drain on Russia's resources. The question becomes, what happens when a bear is backed into the corner? Will they back down, or will they come back out even fiercer than ever before? No matter how you slice it, America's problems are building, and American rivals are piling on global pressure all at once. As many pundits have suggested, we are sleepwalking our way into World War III, and as of yet, we do not have the strong political leadership to deal with it. Finally, with gold long considered a safe haven during times of economic or geopolitical upheaval, gold is now hitting all-time record highs. A thoughtful person might try to understand why gold is rising to historic levels and what is to be done next. Even though the markets have been rising nicely over the last year or so, and we've hit recent new highs, I believe that each and every investor should carefully weigh the risks in the background versus the apparent opportunity in front of us. As before, I would continue to recommend great caution and to be sure that your investments reflect your personal view of the state of our planet. Finally, don't forget to vote. And as always, if you would like to discuss, please don't hesitate to reach out.